Gentlemen, if you trade in the UK market, there's one pair that dominates your screen every single day, GBP USD. It's called Cable, and it's the heartbeat of London. But here's the truth. Most traders don't really understand how this pair moves, why it's so unpredictable, and how to master it. Today, I'm going to reveal the secrets every UK trader must know if you want to survive and thrive in GBP USD. Stay locked in, because if you miss even one of these secrets, you'll keep blowing accounts like the majority of traders out there. Secret 1: London Session Dominance. When you're trading GBP USD, the very first thing you must understand is that timing is everything. It doesn't matter how strong your technical analysis looks. It doesn't matter how many indicators line up. If you're trading at the wrong time, you're fighting against a dead market, and the most important time for GBP USD is the London session. Let's break this down clearly. The Forex market is a 24-hour market. It starts with the Asian session, rolls into London, and then flows into New York. But here's the truth, not all sessions are created equal. GBP USD is known as the cable, and it was historically used to send exchange rates between London and New York via a transatlantic cable. That's why it has always been most active when London is open. Between 8 a.m. and 12 p.m. UK time, GBP USD comes alive. Liquidity floods in. Market makers, banks, hedge funds, they all step into the arena. And when that happens, volatility increases. What does volatility mean for you as a trader? Opportunity. This is when you can catch real moves, not just small back and forth ranges. Compare that to the Asian session. During Asian hours, GBP USD is often stuck in a tight range, moving 20 or 30 pips up and down, teasing you with false signals. Many new traders make the mistake of forcing trades in that quiet environment. They see a breakout during Tokyo hours, jump in, and by the time London opens, the market reverses hard and wipes them out. Why? Because they didn't respect the natural rhythm of GBP USD. Now here's the golden rule. Don't try to fight time. Align with it. If you want to maximize your chances in GBP USD, trade when the pair is active, when London overlaps with New York. That overlap, which happens between 1 p.m. and 4 p.m. UK time, is when both major financial centers are awake. Orders are flying in from both sides of the Atlantic. This is the most liquid, most volatile, and most profitable window for trading GBP USD. But let's zoom in specifically on the London Open. From 8 a.m. to 10 a.m., you'll often see what's called the London breakout. The Asian session builds a small range, like a spring being compressed. And when London traders arrive, they slam the market in one direction, breaking that range. If you know how to identify this setup, you can ride some of the cleanest moves in Forex. However, be careful. The London session is also famous for stop hunts. Market makers know where retail traders set their stops. They'll often push price quickly in one direction to take out those stops, then reverse in the true direction. This is why patience is key. Don't chase the first candle you see at 8:01 a.m. Let the market fake out, let the liquidity grab happen, and then enter when the true trend starts to reveal itself. Another critical thing about London hours is volume confirmation. GBP USD moves differently when there's real institutional volume behind the price. You'll notice candles are larger, momentum is clearer, and breakouts have follow-through. Outside London hours, you'll often see false breakouts. Price pokes above resistance, then immediately falls back. But during London, when the market commits, it often stays committed. So, the first secret every UK trader must know is this: your edge is not just your strategy, it's your timing. If you're trading GBP USD at 2 a.m. UK time, you're setting yourself up for failure. That's not when the pair was designed to move. The market has its natural heartbeat, and your job as a trader is to sync your actions with that rhythm. Professional traders don't waste energy fighting dead sessions. They focus their firepower during the London morning and the London-New York overlap. That's when cable reveals its true character. That's when discipline, patience, and precision pay off. Remember, it's not about how many trades you take, it's about when you take them. Master the timing, and you've already unlocked one of the biggest secrets to surviving and winning in GBP USD. Secret 2: News is king for GBP USD. If you want to survive trading GBP USD, there's one reality: you can't run from news events control this pair. More than any other major currency, GBP USD reacts violently to economic data, central bank statements, and unexpected headlines. And if you ignore this, you're not trading. You're gambling blind. Let's be real. The pound is one of the most politically and economically sensitive currencies in the world. Every word from the Bank of England, every inflation report, every U.S. Federal Reserve decision, it all hits GBP USD like a thunderbolt. Sometimes you'll see 50, 100, even 200 pip moves within minutes. That's not random. That's news-driven volatility. Take the Bank of England, for example. When the BO raises rates or even hints at raising rates, the pound usually strengthens. Why? Because higher interest rates attract more investment into the UK. The opposite is true as well. When the BO cuts or signals weakness, the pound falls. This is why you, as a UK trader, must know the BO calendar like the back of your hand. If you don't know when Governor Andrew Bailey is speaking or when the next MPC meeting is scheduled, you're stepping into battle blindfolded. But it doesn't stop with the UK side. Remember, GBP USD is a war between two giants, the pound and the US dollar. That means the Federal Reserve is just as important. When Powell or the Fed signals a policy shift, the dollar moves and GBP USD reacts instantly. For instance, if the Fed turns hawkish, hinting at rate hikes, the dollar gains strength and GBP USD usually drops. If the Fed signals easing, the opposite happens. Here's the trap most retail traders fall into: they trade technical setups without even checking the news. They see a clean breakout forming on their chart. They enter, and then, boom, 5 minutes later, an inflation report drops and wipes them out. The candle doesn't care about their moving averages, their Fibonacci levels, or their patterns. The candle is reacting to real money flowing after real news. So, what's the secret here? Preparation. Before you take a trade on GBP USD, you must check the economic calendar. Websites like Forex Factory Investing.com or even the official Bank of England and Federal Reserve calendars are free tools, yet most traders don't bother. Professionals know the schedule inside out. They know which events matter and which are noise. And let me tell you, not all news is created equal. Minor data like housing starts or low-impact surveys may not move the market much. But high-impact events, CPI, interest rate decisions, non-farm payrolls, FOMC statements, those are the killers. Those are the events where GBP USD comes alive, where spreads widen, where accounts blow up, or fortunes are made. The second layer of this secret is understanding how to trade around news. Do you enter before? Do you wait until after? Do you straddle both sides? The answer depends on your style and your risk tolerance. Aggressive traders sometimes position early, predicting the outcome. Conservative traders wait for the dust to settle, then catch the trend that follows. There's no one right way. But there is one wrong way trading without knowing what's coming. Here's a pro tip. GBP USD often creates fake moves in the first seconds after a major announcement. That's the market clearing stops, shaking out weak hands, before choosing its true direction. If you can master the patience to wait through that noise, you can ride the real move with much less stress. Finally, let's talk mindset. News trading requires emotional discipline. When you see a 50-pip candle explode in seconds, your heart races, your palms sweat, and you feel the urge to jump in. But discipline means holding back until you have clarity. Remember, markets will always be there tomorrow, but your account won't if you blow it chasing every spike. So the second secret every UK trader must know is this: GBP USD lives and dies by the news. You don't have to predict the future, you just have to respect the calendar. Stay aware, stay prepared, and trade with the flow of information, not against it. Because in the world of GBP USD, the trader who ignores the news is already defeated before the battle even begins. Secret 3. Respect the pound's personality. Every currency pair has its own rhythm, its own character. The yen behaves differently than the euro. Gold doesn't move like oil. And when it comes to GBP USD, the cable, you must learn to respect its personality. Because if you don't, it will eat you alive. So what makes the pound unique? Unlike other majors, GBP USD is emotional, volatile, and deceptive. It's like a fighter who fakes one way, then strikes from the other. Traders who don't understand this keep getting knocked out. Let me explain. GBP USD is notorious for its stop hunts. You'll often see this pair spike aggressively in one direction, wiping out stops above or below key levels before reversing into the true move. Why does this happen? Because the pound is heavily traded in London, where big banks and institutions know where retail orders sit. They exploit that liquidity, grabbing stops, before unleashing the real trend. This is why one of the most important skills in trading GBP USD is patience. The first move isn't always the real move. At the London Open, for example, you might see a sudden breakout that looks like the start of a huge rally. Many retail traders jump in, only to watch the market slam back the other way. The pros wait. They let the manipulation happen, then ride the second wave, the one that actually matters. Another personality trait of the pound is its speed. Compared to pairs like EUR to USD, GBP USD tends to move faster and with larger candles. What looks like a small retracement can turn into a 50-pip reversal in minutes. If you're not ready for that, if your stop losses are too tight, you'll get stopped out over and over again. The secret? Give the pound room to breathe. Respect its volatility when sizing your trades. Now let's talk about structure. GBP USD often respects levels of confluence more than simple trend lines. What do I mean by that? The pound doesn't care about just one moving average or one support line. But when you combine multiple signals, a key psychological level like 1.3000 plus a Fibonacci retracement plus London session timing, suddenly you have a level the market actually respects. That's when GBP USD shows its hand. But here's the danger. The pound loves to fake those levels first. You'll often see false breakouts, where the price pushes just beyond support or resistance, traps traders, and then snaps back. If you don't respect that personality, you'll keep losing. Smart traders expect the fake. They wait for confirmation before entering. Let me give you a mindset shift. Think of GBP USD as a predator. Its job is to hunt weak traders. Every time you act emotionally, every time you chase the first spike, every time you move your stop out of fear, you're feeding the predator. But when you stay patient, disciplined, and wait for it to reveal its true move, suddenly you're the hunter. Another thing that makes the pound unique is how it reacts to sentiment. Political uncertainty, Brexit negotiations, UK elections, all of these have historically caused GBP USD to whipsaw violently. Even today, comments from policymakers can cause massive intraday swings. So when you trade this pair, you can't just rely on the chart. You must also respect its sensitivity to headlines. Now, here's a critical point. GBP USD will test your mental toughness more than most pairs. You'll get faked out, you'll see violent swings, and you'll feel the temptation to quit. But that's exactly why mastering the pound builds real trading discipline. If you can trade GBP USD with consistency, every other pair feels easier. So the third secret every UK trader must know is this: the pound has a personality, and you must respect it. Don't chase its first moves. Don't underestimate its volatility. Don't ignore its tendency to manipulate. Instead, learn its habits, adapt to its rhythm, and stay patient. Because if you treat GBP USD like a simple, predictable pair, you'll keep bleeding accounts. But if you respect its wild, deceptive nature, you'll finally stop being prey and start becoming the predator. Secret 4: correlation with dollar strength. If you're trading GBP USD, you need to understand one simple truth. This pair is not just about the pound. It's a constant tug-of-war between two currencies, the British pound and the US dollar. Too many traders make the mistake of staring only at GBP charts without realizing the second half of the battle. But the secret is this: GBP USD will always dance to the rhythm of dollar strength. Let's break this down. The US dollar isn't just any currency. It's the world's reserve currency. It's involved in nearly 90% of all Forex transactions. That means whenever the dollar moves, the entire Forex market shifts. And GBP USD, being one of the most heavily traded pairs, reacts directly to it. So how do you measure dollar strength? The answer is simple: the US dollar index, DXY. The DXY is a basket of currencies measured against the dollar, with the euro having the largest weight. When DXY rises, the dollar is strong. When DXY falls, the dollar is weak. And GBP USD almost always moves in the opposite direction. Think of it like this: if the dollar is gaining strength, GBP USD usually drops, because it takes fewer dollars to buy 1 pound. If the dollar weakens, GBP USD rallies, because it takes more dollars to buy the same pound. This inverse correlation is one of the most powerful tools in a UK trader's arsenal. Now here's where most traders mess up. They only look at the GBP USD chart. They see bullish signals and jump in long, but when they zoom out, DXY is showing dollar strength, meaning GBP USD is actually likely to fall. Without that extra layer of context, they end up on the wrong side of the market. A professional trader never ignores DXY. Before entering a GBP USD position, they ask, what's the dollar doing? If the dollar is trending strong, you don't blindly buy the pound. If the dollar is collapsing, you don't fight it by shorting GBP USD. You flow with the bigger tide. Let's go deeper. The dollar is influenced by several key factors. Federal Reserve policy. If the Fed is hawkish, raising interest rates or signaling cuts less aggressively, the dollar strengthens. Risk sentiment. In times of global fear, wars, crises, recessions, the dollar often acts as a safe haven. Investors pile into it and GBP USD falls. US data releases strong NFP reports, rising inflation, or GDP growth usually strengthen the dollar. Weak data weakens it. This means that even if the pound is stable, GBP USD can move dramatically based on dollar flows alone. If you're ignoring that, you're missing half the story. Here's a practical tip: put the DXY chart right next to your GBP USD chart. Watch how they move. Often, when DXY breaks a key resistance, GBP USD will break support at almost the exact same time. This gives you confirmation, reduces false signals, and massively improves your win rate. Another thing to respect is correlation with other dollar pairs. If EUR/USD is spiking higher, GBP USD often follows, because both share that inverse relationship with the dollar. Watching multiple dollar pairs together gives you even more clarity. But let me be clear, correlation isn't perfect. Sometimes GBP USD will move differently because of unique UK news or pound-specific sentiment. For example, a surprise Bank of England announcement can override dollar flows for a while. That's why you must combine both sides, pound fundamentals and dollar strength, to get the full picture. And here's the mindset piece: GBP USD is a battlefield. If you only focus on your soldier, the pound, you're blind to the enemy, the dollar. A general who ignores the opposing army loses the war. But when you watch both sides, you anticipate moves instead of reacting. You see the bigger strategy unfolding. So the fourth secret every UK trader must know is this: GBP USD is not a solo act. It's a do-it. Respect the dollar, track its strength through DXY, and align your trades with the bigger flows. Because in this market, the dollar is the tide, and the pound is just the boat. If you follow the tide, you'll ride smooth. If you fight against it, you'll sink. Secret 5: risk management is non-negotiable. Let me tell you a truth most traders don't want to hear. You don't lose because of bad strategies. You lose because of bad risk management. And nowhere is this more true than when trading GBP USD. The pound is one of the most volatile majors in the Forex market. This pair can move 50 to 100 pips in minutes when London and New York overlap, and during news events, it can spike even more. If you're trading this beast without a plan to protect your capital, you're finished before you even start. So why is risk management so critical here? Because GBP USD is unpredictable. It doesn't always respect clean patterns. It fakes out, it hunts stops, it slams hard in one direction, and then reverses without warning. If you're risking too much on one trade, one bad move can wipe you out. That's why professional traders survive and retail traders blow up. Let's break it down into principles every UK trader must follow. 1. Never risk more than you can afford to lose. This isn't just a cliché, it's survival. If you're risking 10-20% of your account on a single GBP USD trade, it's only a matter of time before you're wiped out. The pros risk 2% max per trade. That means even if they lose 10 trades in a row, they're still alive. Risk management isn't about protecting one trade. It's about staying in the game long enough to win over time. 2. Use stop losses, not hope. Hope is not a strategy. Too many traders open a position and say, "I'll just wait for it to come back." Meanwhile, GBP USD keeps dropping another 100 pips and wipes out their account. You must have a stop loss in place. Not only does it protect your account, but it also protects your mind. Without a stop, your emotions take over, and emotions are the fastest path to destruction. 3. Size your positions correctly. Position sizing is the bridge between your account balance and your stop loss. Let's say you're willing to risk 1% of your account on a trade. If your stop is 50 pips away, your lot size should be smaller. If your stop is 20 pips away, your lot size can be bigger. Most traders ignore this math. They throw in random lot sizes and wonder why they blow up. Professionals calculate risk down to the pip. 4. Expect GBP USD to move big. Here's where many traders fail. They set stops that are too tight. GBP USD breathes in big swings. If your stop is only 10 pips, the market will stop you out in normal noise. You need to study the average daily range and give your trades room. That doesn't mean using wider stops blindly. It means adjusting your position size so that a wider stop still keeps your risk small. 5. Don't overtrade. This is a hidden part of risk management. Every time you open a trade, you're exposing yourself to risk. GBP USD moves so often that traders feel the urge to trade every wiggle. But real discipline is knowing when not to trade. Overtrading drains your account and your psychology. Sometimes the best trade is no trade. 6. Protect your profits. Risk management isn't just about losses. It's also about securing wins. GBP USD can reverse fast. If you're up 50 pips and you refuse to move your stop or take partial profit, you can watch the market take it all back. A professional knows when to lock in gains, trail stops, or close partial positions. Now let's talk mindset. Risk management is the difference between being a trader and being a gambler. A gambler chases excitement. A trader protects their capital like it's their lifeline, because it is. Your account balance is your weapon in this war. Once it's gone, you're out of the fight. Here's the truth: you can't control the market, but you can control your risk. And that's the only control you truly have. So why would you throw that away? The fifth secret every UK trader must know is this: risk management is non-negotiable. Without it, even the best strategy will fail. With it, even an average strategy can succeed, because in GBP USD, survival is victory. Stay alive and the profits will come. Blow up and the game is over. Secret 6, the power of patience. If there's one word that separates the traders who last from the ones who blow up, it's this: patience. And when it comes to GBP USD, patience isn't just a virtue, it's a survival tool. The pound moves in bursts. It consolidates, traps traders, then explodes with speed. If you don't have the patience to wait for the right setup, you'll get caught in the noise every time. And the truth is, most retail traders don't fail because they don't know strategies. They fail because they can't sit on their hands. They can't wait. Let's break it down. 1. The market rewards the waiter. GBP USD often ranges during the Asian session, building pressure. Then, when London opens, it breaks out. Impatient traders try to force trades inside that small range, thinking they're catching a trend. But when London traders arrive, the market wipes them out. The disciplined trader waits, watches, and strikes only when volatility confirms the move. One good trade at the right time can be worth 10 bad trades made out of boredom. 2. Patience filters the noise. The pound is noisy. Fake breakouts, stop hunts, sharp reversals. This is normal behavior. If you jump in at the first sign of a move, you're feeding the market your stop. Patience means letting the noise play out, waiting for confirmation, and only acting when the odds are in your favor. Think of it like hunting. A skilled hunter doesn't fire at the first rustle in the bushes. He waits until the target fully reveals itself. That's trading GBP USD with patience. 3. Patience with entries. Too many traders hit buy or sell because they're afraid of missing out. But FOMO, fear of missing out, is the fastest killer in Forex. You must learn to let trades go. If you miss the move, so what? There will always be another one. GBP USD is open 5 days a week, 24 hours a day. The market will not run out of opportunities. But your account will run out of money if you keep chasing every candle. 4. Patience with exits. Patience isn't just about waiting to get in. It's also about holding your winners. Many traders cut profits too quickly. They see 20 pips in profit, get nervous, and close out. Then GBP USD runs another 80 pips in their direction. Why? Because they lacked patience to let the trade develop. If your analysis is solid, if your risk is managed, trust the trade. Let the market pay you for your discipline. 5. Patience builds discipline. Here's the deeper truth. Patience is not just about time. It's about control. It's about mastering your emotions. Every time you sit through a fake move without reacting, you're training your brain. Every time you let a setup fully form before entering, you're building discipline. And discipline is what separates professionals from amateurs. 6. The long game. Patience also applies to your journey as a trader. Too many UK traders want to flip accounts overnight to double their money in a week. But trading isn't a lottery ticket, it's a business. Building consistency takes months, even years. The secret is to stop chasing instant results and start thinking in terms of growth. Survive today, survive tomorrow, and the compounding effect of small, consistent wins will change your life. Now, let's be clear, patience doesn't mean inactivity. It doesn't mean sitting on the sidelines forever. It means waiting with intention. It means knowing exactly what you're waiting for. When your setup appears, you act with confidence. When it's not there, you stay out without hesitation. That balance between patience and precision is the mark of a true professional. So the sixth and final secret every UK trader must know is this: patience is power. The impatient trader keeps feeding the market their money. The patient trader waits, survives, and grows. Remember, in GBP USD, the money doesn't go to the trader who trades the most. It goes to the trader who waits the longest for the best opportunity. Because in this market, patience isn't just a skill, it's the weapon that keeps you alive.